Hello everyone, hope you all are doing well. Welcome to today's class. In this class, we're going to be discussing paper 1-2 of accounting, the October-November session of 2024. If you're watching this lecture, you probably know that this paper is an MCQ-based paper of 30 MCQs with the time of 1 hour. So let's just jump right into it and discuss each question as we go. So question 1, a business sells computers. When it values its inventory, it excludes the value of the inventory that is more than 1 year old. This is because it may be obsolete. Which accounting principle does this demonstrate? So this question put forward a situation, and it also gave you the solution. However, it's asking you why the company is doing that. So let's discuss each option. The first option is going concern. Going concern means a case in which a company can continue its operations beyond 1 year, which does not apply here, so this one is incorrect. The second one is historical cost. Again, this does not apply here because it refers to something totally different, so this is also incorrect. What about prudence? Prudence refers to the concept of conservatism. Prudence tells us to anticipate losses before they arise, but not to anticipate gains. This leads to a lower but more reliable figure and the profit figure. So in this case, the correct answer is prudence. However, let's discuss the last one too, realization. Realization isn't about reducing inventory for obsolescence of the inventory. So this is also not applicable. This instead refers to realizing something when it happens. So when we know for sure, this question says that this is because it may be obsolete. But in the case when we know it's obsolete, then we would realize that loss and we would take it to the P&L as a loss. All right, so realization is also not applicable. So in this case, the correct answer is option number C, which refers to prudence. All right, moving on, a purchase ledger clerk has to use a password. Purchase ledger clerk has to use a password to access the ledger in a computerized accounting system. What is the purpose of the password, right? So passwords restrict access, so only the authorized users can use the purchase ledger. All right, and so when we get to the statements, we have to decide which ones are correct. So the first one is to limit access to the purchases ledger by others. By others, it refers to people who are not authorized to use that. Unauthorized people. All right, so this one is correct. What about the second one? To prevent the clerk accidentally deleting a supplier's account. Is this true? No, it's not true, because this the password doesn't inherently stop accidental deletion. This is just permissions or the design issue of the software. It does not tie up with the the password itself. So this is also incorrect. And the third one is to stop the clerk recording a fraudulent or unauthorized invoice. Also, this is not correct. This is this does not refer to the whole situation. The password is only to allow the authorized clerk to log in and use it. So this one is also incorrect. So the only correct answer is 1. So the option number B is correct. All right, moving on. Sorry about this. So moving on, Peter is a credit customer of John. Credit customer. Each word is very important, so pay attention to every option here. Peter is a credit customer of John. He settles his account of $200. He pays by check and receives a cash discount of 5%. Which entries are made in John's books? Not Peter's books, John's books. All right, of account to record this transaction. So if you're John, or if anyone is John, what entries will be entered into his account? So if you are John, you will be receiving the money, you will receive the check. So your account will be debited by whatever the amount is, and your account will be credited by Peter's account. Peter does not owe you money anymore, so Peter will be credited. However, bank will be debited. In this case, Peter owed you 200, but he only paid 190. So where does the other 10 go? It is also debited, but by what? The other 10 is debited by an expense, a sort of expense that is occurring when you allow a discount to Peter, right? So it will be debit discount allowed. So the correct answer is option number A. This is the correct option. Moving on, which item is capital income? So what is capital income? Capital income is a non-recurring. Capital income is a non-recurring inflow, a non-recurring income. It's not from your business. You're not continuously accruing. You're not continuously earning capital income, right? So in this case, it is non-recurring. All right, it is usually related to non-current assets, related to non-current assets, or financing, whatever it is. So in this case, we have to decide which one is non-recurring inflow. So let's go over each one. Bank interest received. So if you have put money in the bank, there will be terms decided with the bank to give you the money. So the terms can be in various time frames. It can be monthly, it can be quarterly, it can be semi-annually, it can be annually. So it is a recurring inflow unless you take the money out of the bank. So this one is incorrect. So, and the second one is proceeds from sale of business premises. So how often do you sell business premises? You don't. Business premises are kept safe. They are being used, and this is also from a non-current assets, as I discussed here. On the right hand side, I mentioned that. So this one is correct, but let's discuss the other ones too. Rental income from property. So if you're living in a rented home, or you own a rental property, you get your cash monthly, quarterly, semi-annually, whatever the terms are. So it is also a recurring cash flow. So this one is also incorrect. And the last one is sale of inventory to a customer. As I said, inventory is being moved. You are continuously selling your inventory to gain money, otherwise your business won't work. So this is also recurring, so it is not capital income either. So the correct answer is option number B, proceeds from sale of business premises. All right, so the draft profit for the year of a business is $53,000. During the year, the business acquired new premises and included the following costs in the cost of the premises. So what are the costs? Legal fees and insurance. The business does not charge any depreciation on the premises. So there will be no depreciation expense. So in this case, we will have to capitalize the legal fees of the premises, right? Because as you read in your studies before, legal fees are capitalized whenever an asset is bought. So it will not be expensed out. Not expensed out. So this will not be subtracted from the total draft profit, which is $53,000. This will have no effect on that. However, insurance is not capitalized. It is a revenue expenditure, so it will be subtracted from the as a cost from the total profit. So this will be expensed out. So what is going to happen? $53,000 is going to be what? Will it be affected by the legal fees? No. So there will be no expense. And what about the insurance? It will be expensed out. So it will be minus $4,500, which will give you $48,500. So the correct answer in this case is option number B. Moving on, the non-current assets can be depreciated using a number of methods. How is the most appropriate method decided? This is a purely theoretical question, and so we have to decide which method to use. We'll go over each option and decide the best one. The method chosen improves the profit for the year of the business. No, this relates to fraudulent activity. Actually, I'm an auditor, so I know that some companies try to use this to increase their profits. So this is no. This is a big no from a legal standpoint as well, because this is fraudulent. This is just my opinion. I don't know if they taught you that. All right. So the method chosen is easily understood by the users of the financial information. Yes, it is very important that the users of the financial information do understand the methods that you are using. The financial statements should be made that way. However, the correct method, the most appropriate method, is not decided by keeping in mind that consideration, because we have to choose the method that reflects the state of the asset most appropriately. So this is also incorrect. What about the third one? The method chosen is easy to calculate. So if you chose, for example, the straight line method, so that would be very easy. You're just going to have to divide the cost by the remaining life, right? However, that is not the case. That is not the most primary thing that you use. That is not a consideration at all. So this one is also incorrect. What about the last one? The method chosen reflects the pattern of use of the non-current assets. Exactly, that one is totally correct. Your asset and your assets depreciation will be decided by how much and how you use it. So that is correct. This one is correct. So the correct answer is option number D. All right, moving on. Ryan purchased a van of $16,000 on 31st December 2021. It is his policy to apply 25% per annum, reducing balance depreciation for each part of the year the asset is held, which means that it is apportioned on time basis for each part of the year the asset is held, right? So Ryan traded the van in on July 2024 for a $6,150 reduction on the cost of a new van. All right. So what was the profit or loss made on the disposal of the van? So we have to compute the profit or the loss. So let's just solve it quickly. So the net book value at the end of 2022 would be what? It would be $16,000 multiplied by 75%, or you can just do this, $16,000, which was the initial amount, minus the depreciation, which would be $16,000 into 25%, giving you $12,000, right? So that was the net book value at the end of 2022. Moving on to 2023, it would be $12,000 minus $12,000 into 25%. So why didn't we take $16,000? Because it is not being measured on straight line. It is being measured on reducing balance. Reducing balance method uses the latest net book value for the depreciation itself. So in this case, it was $12,000. So it will be, the depreciation will be calculated on $12,000. So this would give you $9,000. So at the start of 2024 or the end of 2023, it's the same thing. The net book value was $9,000. So for 2024, it was sold on 1st July, right? So we won't calculate the depreciation for the full year. In these two cases, depreciation is for the full year. However, for the last one, for 2024, it will be only calculated on for 6 months. So what we're going to do is we're going to take the net book value opening, which was $9,000, minus $9,000 again into 25%. However, we're gonna do this. We're gonna apportion it for 6 months. It was sold on 1st July, so 1st January to 30th June. That was 6 months into 6 divided by 12, which would give us 7,875, right? So and then the van was sold for $6,150. It's mentioned here. So just gonna subtract profit or loss bracket. So 6,150 minus 7,875, which gives us a loss of 1,725. So is there an option? Yes, that's here. Option number B, $1,725 of loss. All right, I hope you got this. Moving on, these were the basics, I'd say, of depreciation that you were taught in your class. If you did not understand this, or if you had troubling understanding depreciation, do contact me and I'll help you out, okay? So moving on, the totals of the trial balance of a business did not agree, which is a big red flag, all right, when working in the real life as well. So the following errors were discovered. The wages account had been overcast by $550, right? And the sales account had been undercast by $400. A credit sale of $150 had been recorded on the sales invoice as $510, which means that it was understated by how much? 510 minus 150, which gives us around $360, right? So after the appropriate corrections were made, the trial balance totals agreed. What was the difference between the trial balance totals before the corrections were made? So tell me, what was the difference between the trial balance totals? So tell me. So where were we? We were discussing what was the difference between the trial balance totals before the corrections were made. So let's go over each error. So in this case, the wages account had been overcast by $550. The wages account itself is an expense. So it is of what? Credit nature. It is an expense. So it is what? Of credit nature, right? So if it was overcast by $550, what does that mean? That means that it was credited by $550 more than it should have been, right? It was credited by more than $550. It should have been less than it would should have to correct this. It should be debited by $550. So this was actually credited by $550. Sorry, yeah, this was credit. Apologies, apologies. Yeah, so this is an expense account and it is of a debit nature. Apologies, this is of a debit nature, right? So because this is an expense account, this was debited by $550 more than it should have been. So this is debit. This is the incorrect entry, right? Incorrect. And what about the sales account? The sales account is revenue, so it is a what? It is a credit account. However, this account was undercast by $400, meaning this account was debited by $400. It was not credited what it should have been. It should have been credited. However, it was debited. So the incorrect entry was debited by $400. All right, $400. So the last one, a credit sale of $150 had been recorded on the sale invoice as $510. So how are we going to approach this one? Because it was a sale, we're going to the incorrect entry was the difference between 510 and 150. No, this will not change the trial balance. Why? Because this was a credit sale. So when we make a credit sale, the entry being done is debit receivables, right? Receivable from whoever the person is, and we credit the credit sales, right? So in this case, if we debited we made a credit sale and we recorded it as 150, receivable would also show 150 instead of 510, right? So it would be 150, 150. The trial balance was balanced. There was no difference between the two at all. However, if this was cash, if this was not a credit sale, right, this would have been this would have been cash debited by 510 because we received the cash. So there would have been a difference of $360. However, that is not the case. So here it was a credit sale. This did not change the trial balance itself. So this will not be considered. This will have zero impact. So the net difference was $900, right? So let's see if there was an option for $900. This was, oh, sorry, $950. $950. So yeah, option number D is $950. Option number 3, a credit sale of $150. This was incorrect. This does not have any effect on that. All right. So moving on, question number 9. In the books of a trader, discounts received of $1,400 have been posted correctly in the supplier's accounts, but debited in the discounts allowed account, which means that the discounts received were wrongly debited to discounts allowed. However, the supplier accounts were correct. So to remove the wrong debit, we must credit the discounts allowed. To remove the wrong debit, this one, but debited in the discounts allowed account. To remove this incorrectly recorded expense, we should credit it, right? Credit discounts allowed by what? We will credit it by $1,400. And to record the correct entry, which was discounts received, we will again credit it because it is a sort of income. So it would be discount received, right? We would credit this by $1,400. So what are we going to debit? We cannot debit the supplier's account because they are correct. So to do that, we will have to debit the suspense account. Suspense account. By what amount? We will debit it by $2,800. Why? Because the total credits in this case were $1,400 to rectify the mistakes that were debited to the discounts allowed account, and to record the correct entry in the discounts received account that was of $1,400. So in this case, option number A is correct. We will debit the suspense account by $2,800 and we will credit the discounts allowed by $1,400 and discounts received by $1,400 again, right? Moving on, what are the advantages of preparing a bank reconciliation statement? So there are 3 options and we have to choose which ones are correct. So it eliminates the risk of fraud in banking transactions. Does it? No, it does not. It does not, because the banking transactions, they're linked to the bank. They are not linked to, your bank recon. The bank recon does not have anything to do with the banking transactions, right? So this one is incorrect. The next one is, it helps to identify errors in the bank statement. Yes, this is correct, because that is one of the biggest purposes of making a bank reconciliation statement. All right, so then we will check the third one. It helps to identify out of date checks. This one is also correct. So, the bank reconciliation also accounts for out of date checks which cannot be cashed in. So, this one is also correct. So, the correct option is option number D, which says 2 and 3 are correct only. All right, moving on. The cash book of a business showed a debit bank balance of $3,900. This differed from the bank statement balance. This one is also, a bank recon question. The bank statement included bank charges of $250, a direct debit of $3,280, and a credit transfer of $300. None of these amounts have been entered in the cash book. So these are, not entered, they are not accounted for. A payment of $620 entered in the cash book had not yet been presented for payment. What was the balance on the updated cash book? So we'll have to, make a bank reconciliation. So in this case, we're going to do this. We're going to have to adjust certain items, which would be bank charges. In this case, they were of $250, right? The direct debit, the 250 is done. Direct debit of 3,000, direct debit of $3,280, right? And the last one would be the credit transfer of $300. So what is going to be the nature of these? These would be credited. This would also be credit. This would be debited, right? But what about the unpresented check? The unpresented check of $620. It stays out of the cash book because it's a reconciliation item. This is a reconciliation item. So this stays out of the the cash book itself. So the updated cash book, would show us the balance of $3,900 minus the $250 which were credited, and minus the 3,280 debit balance, plus the credit transfer of $300, which would give us $670 of debit, right? Because this was a debit balance, this was a credit balance, this was also a credit balance, this was a debit balance. So if the amount is in positive, the last balance is $670 of debit. So option number B is correct. The payment of $620, it is a reconciliating item. It is a reconciliation item. So this will not be considered for, the cash book. It would be entered separately. So the updated cash book would be $670. Moving on to question number 12, which items will be entered in the debit side of the purchases ledger control account? So contra with sales ledger control account. Yes, this would be entered into the debit side, right? Because the sales ledger control account is credited whenever a sales is booked. So the debit side would be the purchase ledger control account, right? The next one is discount received. This should also be included because it pertains to the purchases. It does not pertain to sales. So this would also be, entered in the debit side of the purchases ledger control account. And what about the last one, returns inwards? This will go to the sales ledger control account, right? So this will not be, impacting the purchases ledger control account. So the correct answer is 1 and 2, which is option number A. All right. Now on to question number 13. A company prepared a sales ledger control account. The balance did not agree with the total of the sales ledger balances, which were $42,650. The following errors or omissions were discovered, right? And the question asks, what was the correct total of the sales ledger balances, right? So the first one is, an irrevocable debt of $500 in the general journal had not been recorded in the sales journal, which means the $500 write-off was not posted in the sales ledger, which means that the sales ledger was overstated by $500. So we will have to subtract this amount, right? And the next one was the sales journal has been incorrectly added and must be reduced by $750. The sales journal overcast affects control but not the individual balances, right? This affects the control account, but this does not affect the individual balances. And the question itself asked for the sales ledger balances. It did not ask you about the sales ledger control account. So this will have no impact. All right. So the next one was the sales ledger control account includes the discount received of $400. It should have been discount allowed $600. Again, this is discount received versus discount allowed. Discount received versus discount allowed. The discount allowed and the discount received are totally different things, right? And it is an error in the control account. It is not an error in the individual sales ledger balances. It is a control account issue. It is not the sales ledger balance issue. So this will also have no effect. Sales to the next one is sales to J Brown of $640 have not been entered in his account. I mean, his sale was missing, so this would because of this, the amount was understated. The sales were understated by $640. So how do we rectify the mistakes? The mistakes in 1 and 4, because it was overstated, we would minus $500. And for the question number 4, it was understated, so we would add $640. So the initial balance was $42,650, right? So we would subtract $500 and we would add $640, which would give us a total balance of $42,790, which is option number D, right? I hope you got that one. So moving on. Moving on to question number 14. The current assets of a company include the balances on both the rent payable and the rent receivable accounts. What do these balances represent? So a debit balance on rent payable indicates prepaid rent, meaning you have paid it in advance, right? So this would be prepayment. So this option number D, C and D show that. However, the rent receivable also had a balance, which means that a credit balance on rent receivable indicates accrued income which is owed to you, right? So rent receivable will be accrued. It will not be prepaid. It will be accrued. So option number C contains both these correct options. So this is the only correct option in all these. So option number C is correct. Now moving on to 15. The following information is available for a sole trader. Right? Allowance for irrevocable debts at the start of the year, $1,400. Total trade receivable at the end of the year, $36,000. At the end of the year, it was decided to write off $1,000 as irrevocable debts and maintain the allowance for irrevocable debts at 3% of trade receivables. What is the entry in the allowance for irrevocable debts account? So in this case, you have to understand that the total trade receivables were $36,000, and this is the amount before adjustments. Right? Adjustments for what? The amount that is already written off. So first we would have to write off the $1,000, which would give us a balance of $36,000 minus $1,000, giving us $35,000. This is the actual balance. And so we record it at 3% of trade receivables. So multiply this by 3%, which would give us a balance of $1,050. The opening allowance was, so wait, this $1,050 is the closing balance, right? This is the closing balance. So what's the opening balance? The opening balance was $1,400, and now it is $1,050. So it is reduced by $350. So what is going to happen when an allowance is reduced by $350? It will be debited, right? The amount here is $350, here it's also $350. But if a provision is being decreased, it will be debited, right? Because it itself is a credit account. So if it is being decreased, it would be it would be debited. So option number C is the correct option in all of these. All right, question number 16. A sole trader's statement of profit or loss shows the following information: opening inventory of $5,000, operating expenses of $3,000, and the profit for the year was $5,400. Closing inventory is 10% less than the opening inventory. Closing inventory is 10% less than opening inventory. We have the opening inventory, so the closing inventory is 10% less, which means that it's $3,500, right? All goods are sold. All goods sold are marked up by 50%. So if you had something of $100 in your inventory, it would be sold at $150. What were the purchases for the year, right? So we have the profit for the year. This is $5,400, and the expenses of $3,000 given here imply gross profit. So the gross profit in this case, would be gross profit. We are working back in this case. Gross profit in this case would be the profit for the year plus the operating expenses, which were $3,000. This would give us the gross profit, which means only sales minus the purchases, right? So this would be $8,400, right? So this is the gross profit, right? So now the cost of goods sold, this would be, I'll just write it as COGS. This would be opening inventory plus purchases minus the closing inventory, right? So we're just gonna start with this. So the we're just gonna rearrange this. So it would be purchases equals cost of goods sold minus opening inventory plus closing inventory. So there's less space here. We're just going to move to the right hand side. So this would be the the cost of goods sold. In this case, it would be it can be found out easily. So it would be purchases equals to, so the gross profit, this was $8,400, right? This means that if something was for 100, if something was costed you 100x, it would be 150x sales, right? This is the goods sold, and this would be this would be subtracted with the closing inventory, which was $4,500. Sorry, this would be subtracted by the opening inventory, which was $5,000, and this would be added with the closing inventory, which was $4,500. Again, going over this one more time because this can be confusing. In this case, the cost of goods sold were 150x minus 100x, right? So if we solve this, so it would be sales minus cost of goods sold, and this would be gross profit. So if sales were 150x because they are sold at a markup of 50% minus 100x, this would give us the gross profit, which was $8,400. We're just going to assume these to be 1.5 and 1, right? These as well, 1.5. This would be 1x, right? So this would be 0.5x equals $8,400, and this would be x equals 8,400 divided by 0.5, giving us $16,800. So this would become $16,800 minus $5,000 of opening inventory plus the closing inventory of $4,500, which was 10% less as given here, giving us the purchases amount as $16,300. This is the correct answer. Going over it one more time. First, we're going to compute the gross profit, which was $8,400. Why? Because we had the profit for the year and we had the operating expenses, right? So when we have that, we have the gross profit. Now we're going to rearrange the formula for cost of goods sold, which was actually opening inventory plus purchases minus closing inventory. But when we rearrange it, it becomes purchases equals cost of goods sold minus opening inventory plus closing inventory. So now we have opening inventory and we have closing inventory. Opening inventory is given in the question, but they say for closing inventory it was 10% less. So 10% less of $5,000 is $4,500. So we have $5,000 here, we have $4,500 here, but we don't have the cost of goods sold. So to compute that, what we're going to do is we're going to take the simple formula of sales minus cost of goods sold equals gross profit. We had the gross profit, and we knew that sales were 1.5 times of what the cost of goods sold were. So 1.5x minus 1x equals $8,400, and then when we solve it for x, we get $16,800, which is the cost of goods sold, right? So now when you put that here, $16,800, we get $16,300. This is the correct amount for the purchases for the year. So the option number C is the correct choice. Now we're going to start to expedite this. So moving on to question number 17, L&M are in partnership, sharing profits and losses in the ratio of 3:2. They have the following current account balances. L had 3,000 credit balance on 31st March 2023, and M had a debit balance of $4,500. And on 31st March 2024, L had a balance of $14,200, which was an increase of $11,200, and M had a balance of $6,200, which was an increase in debit of $1,700. The balances at 31st March 2024 are after taking into account the following: interest on drawings $1,000 and $1,500, interest on capital $3,000 and $2,000, drawings were $10,000 and $15,000. What was the residual profit to be shared between L&M for the year ended 31st March 2024? So the current account balances given for 31st March 2024 are after charging interest on drawings, crediting interest on capital, and posting drawings. To arrive at the correct residual profit, we have to reverse those items across partners and then split the remaining balance in the ratio of 3:2 given above, right? So to do that, we're going to have to do reverse working. And when we do that, it would yield a total residual profit, which consists with the partners' movements and agreed, appropriations agreed ratio, allocating in the 3:2. So this would be, just a second, please. All right. So for this question, it's better if we make, a P account, which will help us understand which is the better approach. So I'll just make one over here for L, and I'll make another one over here for, I'll just make them below so we can see the data from the question itself. So this would be for L, and this would be for M, right? So what were the opening balances? The opening balance for L was $3,000 credit, and for M it was $4,500 debit, right? So for L it would be $3,000 credit opening, and for M it was opening of $4,500 debit. All right, moving on. Now in this case, there is interest on drawings, which would decrease the current account, so this amount would be debited, right? So $1,000 for L and $1,500 for M. So we would just term it as interest on drawings. This would be $1,000 for L, and interest on drawings, this would be $1,500 for M. All right. And then what about interest on capital? $3,000 for L and $2,000 for M. Interest on capital means that this amount will be paid to the owners. So this would increase their current account balances. So this amount would be instead credited to their accounts. So I'll just try it. I interest on capital. This is $3,000 for L, and for M this is actually $2,000. All right. And now we have drawings. Drawings would also be drawings themselves. They also decrease the current account balances for the partners. So $10,000 for L, $15,000 for M. So this would be debited, right? Drawings. This is $10,000 for L, and this would be $15,000 for M, right? And now we have the closing balance. Wait, we are missing one thing, which is the residual profit. So the residual profit is always going to be credited because it increases their credit balance. So we're just going to say residual profit. It would also be credited here. Residual, that's better. Residual profit. Okay, so this amount is not given. So this is going to be our balancing amount, right? So after we take the impact of the closing balances, we're going to, just make this the balancing figure. This is balancing. This is also balancing. So let's just take the closing amounts. So the closing amounts for L was $14,200 credit. So this credit isn't actually, going to the credit side. This just means this was the carried down or the closing amount. So this would be instead debited because the opening was $3,000. The closing would also be, on the debit side as the $3,000 was on the credit side. So the closing would be $14,200, and this account is closed. And for M, it is actually $6,200 debit, which means that it's going to go to the credit side. So the closing would be, would be here. So this would be $6,200. All right. So this account is closed as well. So let's just sum the amounts that do not have, a missing number. So in L's case, this was the debit side. This would come out to be $25,200, and it would be the same over here. In this case, we have $6,000 here, so $19,200 would be the residual profit. All right, and in this case for M, it would be 45. The debit side is closed, so it would be 4,500 plus 1,500 plus 15,000. That's $21,000, right? And for the credit side, this would also be $21,000. And when we take the residual profit to be the balancing figure, it comes out to be it comes out to be 21,000 minus 6,200 minus $2,000. Let me just calculate it. This comes out to be $12,800. So the residual profit for M was $12,800, and for L it was $19,200. All right. I hope you understood this. So to check this, to check if our calculation is correct, we can also, we should sum these amounts first. So 19,800, 19,200, and 12,800. This comes out to be $32,000. And the question said that they are in the ratio of 3:2 for L and M. So for L, it was 3. And for M, it was 2. So 32,000 into 3 divided by 5, right? So it would come out to be $19,200. And for M, it's going to be the same thing, $32,000 multiplied by 2 divided by 5. It comes out to be $12,800. So this is in fact correct. So the answer is $32,000, the whole residual profit. So the correct answer is option number D. All right, moving on. Just a second, please. All right, moving on. A company issued shares at a premium. In which financial statements would the share premium appear? Statement of changes in equity and statement of financial position. Yes, this is the correct answer because the share premium is always reflected in these two. But let's look at the other ones as well. Statement of financial position only. No, this is incorrect. What about statement of profit and loss? No, it does not appear in the statement of profit and loss. And this one is incorrect as well. The correct answer is option number A. Question number 19. The statement of financial position of a company at 31st December showed the following: issued share capital $200,000, 200,000 ordinary shares at $1 per share, right? During the following year, the company carried out the following. On 1st January, the next year, made a rights issue of 1 ordinary share for every 5 ordinary shares. So it was a 5-for-1 rights issue. 1 for 5 rights issue. The share price was $1.50 per ordinary share, and the issue was fully subscribed. All right. And on 1st July, made a bonus issue of 1 ordinary share for every 4 ordinary share. This was 1 for 4. What was the amount of cash received by the company in respect of these transactions? So in the rights issue, it was 1 for 5 on 200,000 shares. So to calculate this, we would, 200,000 shares divided by 5, which means that there were 40,000 40,000 new shares. All right. And for the bonus issue, it included the 40,000 shares from before, and but so it would be 240,000 divided by 4, which means 60,000 new shares. However, the bonus shares do not generate any new cash. They do not generate any new cash because they're bonus shares. They're issued for $0. They're issued for no money at all. So there will be no cash from bonus shares. So the only cash that we're going to receive is going to be from the right shares. So in which case, there are 40,000 new shares and they were issued at $1.50. So 40,000 into 1.5 gives us $60,000. This is the amount of cash that the company received in respect of these transactions. So the correct option in this case is option number B. Which ratio measures the efficiency of a business? All right. So in this case, asset test, no. Markup, obviously not. What about C? Non-current asset turnover. Yes, that refers to the efficiency of a business and how well it's performing with respect to its asset. And return on capital employed, also know this is profitability. So in this case, the correct answer is option number C. Moving on, question number 21. A company's return on capital employed decreased to 10% in the current year from 15% in the previous year. The directors have noted the following changes during the current year. A substantial investment in non-current assets was funded by the new debentures, by the new debt issued. All right. There was an increase in current liabilities. The expenses to revenue ratio increased, meaning the gross profit decreased. Gross profit decreased. And the rate of interest on the company's large overdraft increased, so the interest expense, it increased, right? Which changes could explain the decrease in the return on capital employed? In this case, a big investment in non-current assets funded by debentures raises the capital employed, right? It raises the capital employed and adds interest expense, which also reduces the operating profit. And the formula is profit divided by return on capital employed. So capital employed also includes, the debentures that were issued. So this would, the relation between the debt and increasing would cause the ROCE to increase as well, which would lead to the, the, sorry, this is capital employed, not ROCE, capital employed. So this would decrease the return on capital employed because the capital employed increased because of the new debt. So this contributed to decreasing the capital employed. So this one is correct. There was an increase in current liabilities. This does not have any expense, so this will not be, it does not enter capital employed at all. So this would have no effect at all. And the expenses to revenue ratio increased, which means that, the profit decreased, which means the return on capital employed also decreased. And the last one is the rate of interest on the company's large overdraft increased. Yeah, this is an issue, but it does not tie to ROC in the same way as number 3 does, in which the gross profit itself decreased quite a bit. So this is not correct either. We're just gonna consider 1 and 3, which is option number B. All right. So question number 22. A sole trader cost of sales is $240,000. The gross profit margin is 20%. What are the sales for the year? This is quite easy. Refer back to the working. So if this was X, this was $240,000, and this was 20% of X, or 0.2X, we could just write this down as X minus $240,000 equals to 0.2X. This would come out to be 0.8X equals $240,000, and X would be $300,000, giving us the answer of option number C. Now, the next one, a business employs machinists to make a single type of product. As demand increases, more machinists are employed. So the relation is directly proportional, right? And every time 8 extra machinists are employed, 1 extra supervisor is needed. Which option best describes the total labor costs? Hmm? So for the machinists, they are, they're quite, they vary directly with the output. So they vary with output. So these are variable, right? So it's either this or this. So what about the supervisors? The supervisors, they are stepped. They are stepped because they increase with 8 labor, 8 labors, right? So they come in increments of 8 labors. So they are stepped. In this case, the option number D correctly shows the picture. So it's option number D. So moving on to question number 24, the inventory movements of a business in a 3-month period are shown. So these are, this is the movement, and the business uses the first in, first out method of inventory valuation. What was the value of inventory at the end of March? So this is the, FIFO method, and under FIFO, issues are priced from the earliest receipts first, leaving the latest costs in an inventory, right? So after processing the period's receipts and issues, the remaining ones are the most recent units, right? So in January, they received $5 units, 100 units, and $6 units for 200 units, right? And in February and March, they issued 50 and 200 respectively. So the balance would be $100 for $5, 200 for $6. And when they issue those, this would be 50, and they will be issued for $5. Their balance remaining is 50, and these are still 200 in February. In March, what's going to happen is that in March they're going to issue 200 units, right? So they are going to be issued at the first 50 are going to be issued at $5. So the remaining balance would be, in this case, the remaining balance in March would be 0, and these would issue for $5, and the remaining 150 would issue for $6, right? So in this case, 150 would be issued, so 50 would be remaining. So the value of the inventory at the end of March would be 50 units at $6, which would give us $300. So the correct answer in this case is option number D. All right. Moving on, the customer places an order for 20,000 bricks. Which costing method will the supplier use to price the order? Right. In this case, an order for 20,000 identical bricks means that the order is produced in a batch. Batch costing, accumulates costs for the same type of, items produced together, and this would be the correct answer. However, I mean, if you look at the other options, job costing suits, unique and customized, uh, jobs. So this is incorrect. This is not applicable here. Marginal and unit costings are not costing items, costing systems for pricing in order in this context. So both of these are incorrect as well. So batch is the correct one. 26. The following budgeted and actual information is available. So the question asks, what would be the company's most suitable overheads absorption rate? In this case, we will pick the rate that best reflects the activity usage. With labor, the driver used, we will use the labor overhead absorption rate. So the budgeted OAR for labor is, we can find it out as in the following manner. So for budgeted overhead absorption rate, this would be for 60,000 given here, divided by $28,750, which would give us $16 per labor hour, right? Just gonna write this in better handwriting. $160 is $16 per labor hour, and for machine it would be for $60,000 divided by 200 hours, which gives us $50 per machine hour. But in this case, the process is more labor intensive. The labor hours are much more higher than the machine hours. So in this case, the one will not be considered. The labor one is going to be considered. And some of you may ask that why aren't we using the actual rates instead of the budgeted rates? So the main thing is that the budgeted figures are more suited, are used to set the overhead absorption rate. The budgeted figures are. So if we were given budgeted and actual figures, we would discard the actual figures. We would only use the budgeted figures. And in the budgeted figures, we had to decide between labor and machine, and we chose to go with labor and not machine. In this case, we will use these hours, and the rate would be $16 per hour per labor hour. So the correct answer is option number A. All right. Now moving on to question number 27. The following information is available from the costing records. By how much are the overheads overabsorbed or underabsorbed? Right. So in this case, we would have to see the budgeted overheads cost, which is $32,000, and the budgeted direct labor hours, which are 4,000 hours. So but when we divide these, this gives us $8 per labor hour, right? So the applied overheads, the actual ones, are $3,900, and when we use these applied overheads, when you use these 3,900 hours into $8 per hour that was budgeted, as I explained above, the budgeted the budgeted rate will be used. So we're going to use that 3,900 into $8. This gives us $34,000. These are going to be the actual overheads. So the actual overheads are greater than the applied overheads. They are greater than the applied overheads, and they are greater in the manner of, I'm sorry, I calculated this one wrong. This is $31,200, and the actual was $34,000, and the actual is greater than the applied ones, $31,200. So we have under absorbed them by the difference between these two. So it would be $34,000 minus $31,200, which gives us $2,800. This is the amount by which they are under absorbed. All right. So the correct answer in this case would be option number C. So yeah. Now question number 28. Which items are included in the calculation of the contribution to sales ratio? For the contribution to sales ratio, the formula would be contribution divided by sales, C divided by S, right? So the contribution is sales revenue minus variable costs. So contribution divided by sales, and contribution means sales minus variable costs divided by sales. So these are the items that are being used. In this case, only this would be variable costs, so this is correct, sales revenue, and this is correct, and nothing else is used, not fixed costs nor sales volume. So the correct answer is option number C. All right, I hope you understood this one. And now moving on to question number 29. So in this question, the question asks, the financial information for selling 6,000 units in August was as follows. We have the selling price of $40, variable cost of $22, fixed cost of $12 per unit, and profit of $6 per unit. So what does the question ask? The question says the selling price was reduced by 10% in September. Which level of sales was needed in September to achieve the same total profit as August? The statement which says which level of sales means the volume of products that we need to sell, the volume of units that we need to sell to get the same profit that we did in August. All right. So for this, we need to figure out what are the things that are fixed and what are the things that can be changed. In this case, fixed costs will remain fixed. Fixed cost will remain fixed, profit will remain fixed in our assumptions, right? However, the selling price, it will decrease, and the variable costs, they will remain the same. So this would be decreasing, this would remain the same, this would remain the same, and this would also remain the same. So what will change? The only thing that are going to change are selling price and the volume of units sold. All right, so how are we going to do that? First, To check what was the fixed cost, we are going to multiply the total amount sold during August, and then take that amount and assume it to be the fixed cost for the month of September as well. So in this case, 6,000 units were sold, and each unit had a fixed cost of $12. So this would mean that fixed costs are 6,000 units multiplied by $12, giving us a fixed cost of $72,000. This is the fixed cost. And what is the profit that we need to maintain for the month of August? It would be 6,000 units multiplied by $6, giving us a profit of $36,000. This is the amount that we need to keep consistent for both the profit and the fixed costs. However, the selling price was reduced, so let's punch those assumptions in this question. So the equation would be the selling price minus the variable costs minus the fixed costs, giving us the profit, right? So the selling price, it was $40 per unit. Now it has reduced by 10%, meaning that only 90% of that selling price is now available. So $40 multiplied by 90. And this would be multiplied by X, right? This would be multiplied by X. Why? X is the volume in this case. Minus, what is the variable cost? It is also 22. It has no change. So 22X, because the variable cost is also linked with the volume, minus the $72,000, right? The $72,000. This amount will remain fixed regardless of the volume that is going to be produced. So it will remain in as a constant, right? And the profit, which would be of, sorry about this, which would be of $36,000. All right. If you solve that, this is 36x minus 22x minus 72,000 equals to $36,000, giving us 14x minus, sorry, equal to, and then we're going to add 72,000 with 36,000, which would give us $108,000, and then we will divide 108,000 by 14, giving us 7,715 units. This is the answer for our question here, meaning that answer number C is the correct choice. All right, moving on to question number 30. Question number 30 states, which statements correctly describe cost volume profit analysis? The first statement is, it assumes a linear relationship between costs, revenue, and volume. It can be used in what if analysis. It is a useful tool in long term decision making. It shows how costs, revenue, and profit change in relation to sales volume. Right? So let's discuss each and every one of these to see which one is correct. So the first statement, which says there is a linear relationship between cost, revenue, and volume, this is correct because the CVP analysis assumes that costs and revenues behave linearly within relevant changes of activity, right? So fixed costs remain constant and variable costs change proportionally with volume. So this one is correct. So the second one is, it can be used in what if analysis. This is also correct because CVP analysis allows managers to perform sensitivity analysis or what if analysis by changing variables such as the volume, right? Such as the volume, the price, the costs, to see what is going to be the impact on the profit itself. So this is also correct. The third one is, it is a useful tool in long term decision making. This is not correct because CVP analysis is primarily used for short term decisions because it relies on assumptions like linearity, that certain things will change, will increase or decrease linearly, right? So it relies on those assumptions, and constant costs may not be true for long term. For example, if we take electricity to be a constant cost, in that case it cannot be the same for like 1 year down the road or 2 years down the road because electricity costs are decided by the electricity providers, by the government. So they change on a regular basis, so they cannot be assumed to be the same for long term decision making, right? So this one is incorrect. The last one is, it shows how cost, revenue, and profit change in relation to sales volume. This is also correct because the core purpose of the CVP analysis is to model how costs, revenues, and profits, they vary in relation to the sales volume, like how they are connected to the sales volume. So this is also correct. So in this case, the correct answer is option number B. So I hope this lecture was helpful for you. I hope you learned a lot of things. I hope that anything that you didn't understand before, now you can understand with ease. And if you have any questions, feel free to contact me. I'll leave my contact at the end of the video or in the description below. Feel free to reach out, and if you have anything to ask, do ask me. I'm here to help you all. And if you would like to refer to private tutoring or anything of the sort, contact me at the number that I will be giving with my contact. So take care, have fun, and happy accounting. Bye bye.